On the other side, let's take a market like the stock market, which has been trending severely up for the last year and has been in almost a straight up trend, almost a vertical move. Number one, that's bad now for call sellers because it's moving straight up. But what's likely to happen to a market like that? Well, it's likely to have a big correction, like it did in 1987. And what happened to people that had sold puts in 1987 is they lost money. So we want to stay away from markets like that. And again, rarely do we ever see a big move in bonds. And it's a market that is, the trend's very slow and is very manageable. And we're going to show you how to manage our bookie positions also. It's very easy to manage those positions. Okay, let's look at the bottom chart for 1 second too, because that's going to be important in our advanced positions. And the bottom chart, it talks about the disparity in premium between option strike prices. Okay, what does that mean? You would think that, let's take live hogs, for example. It's a chart on the left. You would think that all hog options would have the same volatility and the same premium. However, that's not the case. That's not the case at all. And as we can see from this chart, the June 46 hog call volatility level is 22.9, and that's 19% undervalued, where the February 39 call is trading at 29.8, and it's 15% overvalued. So there's a big disparity in premium between these two options. And when that occurs, then we have another position we use, and that's an advanced position that we call a calendar spread. We're going to get into that in a moment. But we just want to let you know that that does exist, and it's something that puts the mathematical odds dramatically in our favor, and we want to be able to take advantage of that also. Okay. This chart is very simple. It looks like just a rounded curve or half a moon. And even though it's very simple, it's probably the most important thing that we're going to look at today, because this chart shows the time decay of an option. And it shows how this is 180 days, 6 months from expiration. The option's time decay is very slow. And as it approaches expiration, say about 90 days out, it really begins to drop. And then close to expiration, it just falls very quickly till finally every option at expiration has no time value. And that's the most important concept of what we do. We are selling time. We are selling time. And time goes on every day. People that buy options are buying time, and they're buying the hope that that market will make a very, very big move quickly. And unless it does make that move, they lose their money. But every day, again, markets are in a non-trending mode 60 to 70% of the time. And every day they're in a non-trending mode, both options lose time value. And you know what? Even if the market begins to make a large move, what happens to those two options? They still lose time value. Now, granted, if the market begins to make a big move like the stock market has over the last year, the call option, for example, will gain value. It will gain value if the move is large enough to defeat the time value. But what happens to the other option we sell in our bookie strategy? Because remember, we always sell two options. We always sell a put, and we always sell a call. What happens to the put option while the call option is gaining some value? The put option loses value. And unless that move is straight up, the put option will lose value quicker than that call option will gain. Okay, so this is a very, very important concept. Remember that time decays every day for options, and that's one of the big principles we're going to use, along with the fact that options are overvalued by their very nature. The biggest sellers of options are floor traders, and they like to sell options, so they want to keep the value up there. They want to keep the value up there, and they more or less set the value. Of course, if there's no one around to buy, then they're out of a job. So they've got to set the value within reason. But they're still the biggest sellers of options, and their job is to keep the value as high as possible. So generally, options are overpriced, and always options lose time value every day. Okay, we're going to now get into our actual bookie strategy, and we want to take a look at the typical neutral option position that we would be the typical bookie position that we would be recommending and some of the rules that we use. First of all, this is a chart, again, of the bond market. And this is similar to the last chart we looked at. And actually, this is the last 4 months during the summer of 1995. And a position we have been recommending is selling the bond 104 put and selling the 122 call. And what we like to do is sell options that are beyond the 6-month range. In other words, we want to be away from where the market's been within the last 6 months. Now, in this case, the call we sold, the 122 call, is not only beyond the 6-month range of this market, it's beyond the 30-year range of this market. Bonds have not been this high for almost 30 years. Okay? Now, the 104 put is below the 6-month lows of this market. So all we're saying in establishing this neutral bookie position is that bonds is going to remain within the range of 104 to 122. And what happens if that occurs, if we're right in that? Well, if we're right, we are going to collect the premium from both options by the time decay of both sides. And again, the tendency of all markets is to remain in a trading range almost 2/3 of the time. So we're taking advantage of the tendency of